Coming up, what is the widow's penalty? The hidden triple hit. Let's define the widow's penalty in plain English. It's the financial squeeze that hits a surviving spouse even when household income falls. Three forces pile on at once. Your filing status switches to single, Social Security shifts to one larger check instead of two, and Medicare surcharges, IRMAA, can kick in based on income from 2 years ago. Fewer dollars coming in, but higher taxes and premiums going out. That's the triple hit. Why does filing status matter so much? The brackets compress overnight. As a married couple, you get wider tax brackets and a larger standard deduction. After loss, you file as single after the final joint return year, which cuts that deduction and tightens the thresholds. Same IRA, withdrawals, and pension payments that felt comfortable as a couple can push the survivor into higher marginal rates. People assume lower income means lower taxes. Not automatically, because the brackets move against you. Now, Social Security. The survivor keeps the larger benefit, and the smaller check disappears. That sounds straightforward until you look at the taxation rules. Social Security taxes use combined income, thresholds that haven't been indexed since the 198s, $25,000 for single and $32,000 for married filing jointly, with up to 85% of benefits taxable when you cross the higher band. As a survivor, you're more likely to land in the 85% zone because your threshold shrank with your new filing status, even if you didn't add new income. One benefit vanishes, but tax on the remaining benefit often goes up. Here's where most people get blindsided. IRMAA. Medicare uses your modified adjusted gross income, MAGI, from 2 years prior to set Part B and Part D premiums. MAGI is AGI plus a few add-backs like tax-exempt interest. For 2026, the first IRMAA threshold is $109,000 for single and $218,000 for married filing jointly. See the squeeze? The single threshold is exactly half, so income that was fine as a couple may tip a survivor over a cliff for a full year of higher premiums. Cross the line by $1 and you pay the higher premium for the entire year. Put it together and you get the hidden triple hit. Higher taxes because single brackets are tighter and the standard deduction is smaller. More of your Social Security taxed because the single thresholds are lower and unchanged since the 198s. Higher Medicare premiums because IRMAA looks back 2 years and measures you against single lines. The real-world impact is bigger than it looks on paper. Example, a couple with moderate pensions and IRA withdrawals sits safely under the first IRMAA tier and in a friendly tax bracket. One spouse passes. The survivor files single next year, keeps the larger Social Security check, takes the same RMD total because they inherited, and boom, crosses a tax bracket edge and triggers IRMAA the following year. Same lifestyle, smaller household, higher outflow. Now here's the thing most people miss. You get one last joint return year in the year of death. That's an opportunity window. It's often the best moment to right-size future RMDs with planned Roth conversions under wider joint brackets, review capital gains, tune withholding, and double-check beneficiary designations. Miss that window, and the math hardens. Another overlooked lever. Social Security, withholding, and timing. Survivors can adjust withholding so they don't get a surprise tax due next April, and they can coordinate the survivor benefits start with RMD season. So provisional income doesn't spike all at once. Small filing choices reduce the tax torpedo effect, where each extra dollar makes more of Social Security taxable. And the quiet lifesaver, appealing IRMAA after a life-changing event. Death of a spouse qualifies. If your current income is lower than the tax return Medicare used, you can file Form SSA-44 to request a reduction. Most survivors never hear about this and just accept the higher bill. Don't. Use the appeal. When you qualify, you can submit online or via your local office with proof of the event and your updated income estimate. Let's do a quick reality check. If this already happened to you, you're not stuck. You can still map your current year MAGI bracket headroom and IRMAA tier. Use qualified charitable distributions. From an IRA if you're 70 and a half or older, QCDs satisfy RMDs without raising MAGI, which also helps keep more Social Security out of the 85% zone. Split withdrawals across December and January to stay under IRMAA lines. Revisit annuity withdrawals that may be LIFO taxed and consider partial annuitization to smooth the tax profile. If loss hasn't happened, you can pre-plan together. Fill today's lower brackets with small, steady Roth conversions while both are alive. Coordinate Social Security claiming, so the survivor keeps a stronger benefit without creating avoidable tax drag. Set red line income caps with a $2,000 buffer below each IRMAA tier. If you remember nothing else, remember this: the widow's penalty is a sequence problem. Filing status shrinks, thresholds drop, and a 2-year IRMAA look-back collides with last year's choices. Once you see the sequence, you can engineer the income story, widen joint year moves, stabilize survivor year income, and appeal surcharges you don't owe. Now that you see the cliff, let's spot the edges you can avoid right now. How IRMAA really ambushes widows and widowers. If taxes are the squeeze, IRMAA is the ambush that shows up late and charges interest in stress. Medicare doesn't care about deductions. It cares about your modified adjusted gross income. MAGI from 2 years ago. MAGI is your AGI plus a few add-backs like tax-exempt interest. That number, not your taxable income after deductions, sets your Part B and Part D surcharges. Here's where most people mess up. They think small withdrawals don't matter. But IRMAA is built as a set of cliffs, not gentle ramps. Cross a line by $1, and you pay the higher premium for the whole year. For 2026, the first IRMAA threshold is $109,000 for single and $218,000 for married filing jointly. A widow who was safe as part of a couple can land over the single line with the exact same habits. That's the ambush. The 2-year delay makes it trickier. Choices you make this year show up in premiums the year after next. A December, just to be safe, withdrawal, a capital gain, or a big conversion can quietly raise your 2026 or 2027 bill. You don't feel it now, so it doesn't trigger caution. That's why we calendar decisions and build buffers. Think tripwires, not speed bumps. Each IRMAA tier adds a fixed monthly surcharge to Part B and a separate add-on to Part D. You don't get billed for just the overflow. You get the full tier increase. That's why we never plan to land right on a line. We draw a red line $2,000 below the threshold and protect it. You might be thinking, but I itemize, won't that help? Not for IRMAA. Deductions lower taxable income, but IRMAA uses MAGI before those deductions. This disconnect trips up careful savers. You can optimize your return and still trigger a higher Medicare bill. Once you accept that, everything else clicks. Build a 1-page IRMAA guardrail sheet, current year MAGI estimate, the single or joint thresholds you care about, and your $2,000 buffers. Then, anytime you consider a withdrawal or conversion, you overlay the impact. If the new MAGI breaches your red line, you shrink, split, or delay. Let me show you exactly how tiny moves save real money. A widow needed $14,000 for home repairs. Instead of one December pull, we staged $7,000 in November and $7,000 in January and covered the gap with a small taxable account sale that realized minimal gains. Result: stayed under the single $109,000 tier for both years. Same repairs, zero surcharge. Label your accounts by IRMAA fuel, high IRMAA fuel, IRA withdrawals, Roth conversions, non-qualified annuity LIFO income, large interest and taxable bonds, big capital gains, low IRMAA fuel, basis returns from taxable accounts, Roth withdrawals, QCDs from IRA, they don't hit MAGI, and careful harvesting of long-term gains when bracket space exists. When you need cash, reach for low fuel first. Before we continue, you need to understand partial year sequencing. If you're close to a threshold by September, freeze optional moves and push flexible income into January. If you must do a conversion, do the January split, half in early January, then recheck mid-year. If markets rally, you can skip the second half to protect the line. Common mistakes and fixes: the tiny December top-off. Fix, November freeze and red line review. I'll deduct it. Fix, remember IRMAA doesn't care about deductions. I'll take the free 10% from the annuity. Fix, free of surrender charges isn't free of MAGI. LIFO counts as income. Converting all at once. Fix, steady bracket cap conversions that respect IRMAA buffers. Appeals matter. Death of a spouse is a qualifying, life-changing event. If your current income is lower than the tax return Medicare used, file Form SSA-44 to request a reduction. You can submit online or through your local office. Include proof of the event and your updated income estimate. When it fits, the appeal resets premiums to what you actually earn now, not what you earned 2 years ago. Let's do a quick map. You can copy 3 lines at the top of a sheet. Projected 2026 MAGI, the $109,000 single and $218,000 joint thresholds, and your $2,000 buffers. Under that, list fixed income, RMDs, net of QCDs, pensions, survivor Social Security, expected interest, and dividends. Then add a box labeled optional. Every time you propose a dollar from IRA, annuity, or capital gains, pencil it in and resum MAGI. If it lands above your red line, you either replace with low fuel dollars, Roth, high basis taxable. Split across calendar years. Appeal if a qualifying event applies and current income is lower. One micro story. A recent widow had $118,000 MAGI as a couple under the joint line. The next year, same rhythm landed at $118,000 single. That crossed $109,000, adding surcharges for a full year. We appealed with SSA-44 because her income dropped after his passing and won the reduction. Then we rebuilt with QCDs to satisfy RMDs without raising MAGI and split withdrawals across years. The surcharges didn't come back. If you remember nothing else, remember this. IRMAA isn't about being rich. It's about sequence and thresholds. Manage MAGI, not just taxes. Set buffers, stage income, use low fuel dollars, and appeal when a life-changing event applies. Your income calendar is the shield, the tax squeeze after loss. Now, let's loosen the grip that tightens right after loss. The mechanics are simple but harsh. Filing status flips to single, brackets compress, and the standard deduction drops. Meanwhile, the income pieces don't fall as fast. RMDs still arrive, pensions keep paying, and the larger Social Security benefit remains. Smaller deduction, tighter brackets, similar income. That's the squeeze. Here's the thing most people miss about RMDs. Inheriting doesn't cancel them. If you're already subject to required minimum distributions, those withdrawals continue based on the balance and tables that apply to you as owner or beneficiary. So even if household spending falls, the forced taxable income often doesn't. That stacks on top of the survivor's remaining income and pushes faster into higher marginal rates under single brackets. Social Security taxation jumps quicker, too. The combined income thresholds for taxing benefits are lower for single than joint and haven't been indexed since the 198s, $25,000 for single, $32,000 for joint. The exact same survivor benefit can land deeper into the 50% and then 85% taxable zones. It's not that Social Security changed. The tax math around it did. And it's less forgiving when you file a loan. Pensions and non-qualified annuities stack higher than you expect after loss because there's less room before each bracket edge. Add in an annuity that pays LIFO income when you take withdrawals, and you've got ordinary income landing on top of everything else. That mix can tip you into a new IRMAA tier and make more of Social Security taxable at the same time. The solution isn't to turn it all off. It's to sequence smarter. Before we get to fixes, here's the mistake that costs people thousands: the December safety cash out. Grabbing a big withdrawal just to be safe feels comforting, but it often means you cross a bracket line and an IRMAA tier with only days left in the year to undo it. You end up paying higher premiums the year after next and more tax today for money that may sit idle in checking. Freeze optional moves by November if you're near a line. Quick when you can use right now. Set a red line income cap with a $2,000 buffer below the IRMAA tier you're managing. Write it where you pay bills. When you consider a withdrawal, check the cap first. If it pushes you over, split it across December and January or fund part of the need from low fuel sources, Roth high basis taxable assets, or QCDs if eligible. Let me show you exactly how to map this so you can breathe again. Build a one-page income snapshot for the current year. Top line is your estimated MAGI, then your bracket headroom, then your IRMAA tier with the $2,000 buffer. Add your expected RMD, net of QCDs, pension, and survivor Social Security. Under that, list optional items, discretionary withdrawals, conversions, and potential capital gains. The rule is simple. If adding an optional item cracks your red line, you either shrink it, split it, or replace it with a lower fuel dollar. Once you nail that view, everything else clicks. Here's the playbook in order of impact. RMD control. If charitable giving is part of your life, use QCDs from your IRA to satisfy up to the amount you give. QCDs count toward RMDs, but don't raise MAGI, which helps both IRMAA and Social Security taxation. Withholding tune-up. Increase withholding on pensions or Social Security to avoid April surprises. You'll smooth cash flow and reduce the urge for a rushed December withdrawal. Annuity tactics. If withdrawals are spiky because of LIFO, get quotes for partial annuitization. The exclusion ratio blends basis and earnings in each payment, smoothing taxable income and cutting IRMAA risk. Micro splits. For larger needs, divide the cash across 2 calendar years. A single $12,000 pull might push you over $6,000 in December, and $6,000 in January often doesn't. Medical pairing. Time elective medical or dental work in the same year as higher income. Deductions can absorb part of the tax you'd owe anyway. A micro story. A recent widow had $90,000 MAGI penciled in and needed $15,000 for a roof. A single December IRA withdrawal would have landed her near $105,000 safe. But a mutual fund capital gain surprise arrived. Together, they'd have crossed $109,000 and triggered 2026 IRMAA. We ran the snapshot, shifted $7,500 into January, funded $5,000 with high basis sales, and used a $2,500 QCD for year-end giving. Result: roof done, no surcharge, manageable tax. Precision reminders to keep handy. IRMAA in 2026 uses 2024 MAGI, and the first single tier is $109,000. Joint is $218,000. Social Security taxation thresholds remain $25,000 single and $32,000 joint. MAGI drives IRMAA, not your taxable income after deductions. If you remember nothing else from this section, remember this: You control optional income, the calendar, and the order of dollars. Use buffers split across years, pair income with deductions, and let QCDs and partial annuitization do the heavy lifting. This is where the squeeze loosens, so your survivor year stays stable and your premiums don't jump 2 years later. Pre-planning while both spouses are alive. Let's switch to a fence while you both have the widest brackets, 2 Social Security decisions to coordinate, and time to fix sequence before it fixes you. The goal is simple: smooth income, so no single-year trips at tax or Medicare cliff, and make survivor administration brain-dead simple. Start with a 5-year income calendar. 4 checkpoints each year: March, June, September, November. In March, set your Magi forecast and bracket ceiling. In June, update for dividends, interest, and any RMD projections. In September, decide whether conversions or withdrawals happen now or slide to January. In November, freeze optional moves if you're within $2,000 of an IRMAA line. This rhythm prevents the December oops. Next, fill today's low brackets with steady Roth conversions. Keep a $2,000 buffer below your 2026 IRMAA threshold, $218,000 joint, $109,000 single, and cap by your marginal bracket, not your courage. Quarterly micro-conversions are ideal because you can pause if income drifts up or a fund throws a surprise capital gain. The reason this works is simple. Every dollar moved to Roth won't raise Magi later, won't make more Social Security taxable, and won't push Medicare premiums higher 2 years out. Order of cash matters. Label accounts by IRMAA fuel, high fuel, IRA withdrawals, conversions, non-qualified annuity LIFO income, big interest, large realized gains. Low fuel, Roth withdrawals, basis-heavy taxable lots, and QCDs. Spend low fuel dollars first when you need cash during joint years. You'll reduce the chance of an unwanted IRMAA tier later if one spouse survives with tighter single lines. Coordinate Social Security with survivor math. If one benefit is stronger, consider delaying that one, so the survivor inherits the larger check. Then weave it into your calendar. Use the gap years before that larger benefit begins to accelerate Roth conversions under joint brackets. You shrink the future RMD wave and reduce how much of Social Security becomes taxable later. The thing most people miss is timing the survivor benefit, start month, so it doesn't stack on top of a heavy withdrawal year. Paperwork protects everything you just optimized. Do a beneficiary audit. Confirm primary and contingent beneficiaries on every IRA for a 1K, annuity, and life policy. Use per stirpes where appropriate. For annuities, request in writing whether spousal continuation is available. For trusts, confirm the carrier accepts the language and whether life expectancy payouts are preserved. One missing form can undo months of careful planning. On titling, keep at least one joint operating account with a healthy cushion and ensure each spouse is named on essential utilities and insurance. That avoids frozen fund stress if hospitalization or loss happens. Add a bill autopay list, who drafts from which account, and when to the front of your planning binder so nothing triggers a safety withdrawal in December. Build your guardrail sheet and post it by your bills. 3 lines. This year's Magi estimate, your bracket ceiling, and your IRMAA red line with a $2,000 buffer. Add a small box. Moves allowed before November 15th. If a decision doesn't fit, it waits or gets split across calendar years.